Welcome back. We are now moving into Chapter 3, which is our second module. The focus is going to be on financial statement analysis, not so much long-term planning, but financial statement analysis. We're only going to focus on the first 13 slides in this deck. The main concept is how to standardize financial statements for comparison purposes and know how to compute important financial ratios. You probably already know from the syllabus that the major project in this course is going to be a group project. Now, in a face-to-face class, we call it a group project because everyone's working together. In your case, you're going to be working possibly individually or possibly in groups, depending on what is allowed, given the fact this is online. To the extent that some of you can get together and work in tandem, that's right by me. But again, some people may have unique circumstances where it's almost impossible to collaborate. If that's the case, then I will accept an individual project. You can imagine how difficult it will be if we have 18 students in the class online if I have to grade 18 projects. So ideally, we'd like people to get together and work in groups. That's going to remain to be seen whether everyone is able to do that or not. I digress. So those are the main 2 points we'll be focusing on. 3.1 and 3.2 are really all we're focused on for this particular PowerPoint. Financial statement analysis and ratio analysis. I will expect you, and there's not a lot of expectations on the papers, what is of interest to you and your team. But what I do expect to see is at least 1 year of projections for the public company that you choose. The other item is going to be a ratio analysis, not only for the company you choose, but also for its major competitors. So let me be very clear on this. You are going to be choosing a U.S. publicly traded company, something for which there's data available for at least 3 years back. So I don't want a fledgling company that just started a few months ago. I want there to be at least 3 years of history. I want it to be traded on a major exchange in the U.S., and I want the information to be readily available. One place you may want to look, and I recommend this to all my students, is a website, www.sec.gov. This will give you the 10Ks, which are the annual reports, and the 10Qs, the quarterly reports that have been issued by any publicly traded company. You can just look them up alphabetically. I am reachable. If any of you have questions, by all means, send me an email. Let me know what's not clear. There will be more on the group project as the date approaches, but that kind of gives you the overview. There will be, I think I will probably have one module that is specifically for the group project, so everything will be in one place. Okay, there's such a thing as standardizing financial statements. It's really not as difficult as it sounds. What we're going to do is we're going to have sales be the driver on the income statement, and we're going to have total assets be a driver on the balance sheet. 100% of all the assets will be the total assets. 100% of everything on the income statement will be sales. And so cost of goods sold will be a fraction of total assets. Net income will be a fraction of total assets. Same thing with sales. Sorry about that. Net income will be a fraction of sales. the cost of goods sold will be a fraction of sales. On the balance sheet, accounts receivable will be shown as a percentage of total assets. Inventory will be a percentage of total assets, et cetera, et cetera, et cetera. That's how you have a common size on the income statement or on the balance sheet. The standardization allows you to basically see how the different asset categories or liability categories or income categories are changing over time. And as the company continues to grow, you can see how those percentages are going up or going down. They're also useful for companies that are of different sizes in the same industry. Not particularly useful for different companies in different industries because it might be apples and oranges when you're comparing companies in very, very different industries. Before we get into ratios, let me just underscore one thing. If you do a one-year look forward for the company that you're analyzing, be sure to start with sales. Sales is kind of a driver for a lot of stuff, including cost of goods sold. Selling, general, and administrative expenses are somewhat fixed, or at least a portion of them is fixed. They may not be moving up as quickly with the sales. On the asset side, a lot of things are driven by the sales, including the current assets. The accounts payable and the inventory oftentimes are driven by cost of goods sold. So you've got a couple different drivers on both the income statement and on the balance sheet. Just thought I'd throw that up there. Now, ratio analysis. Ratios allow for better comparisons over time between companies. One of the things I mentioned for your group project is that as you do the ratios for the company, that you include also the ratios for its competitors. We're going to break the ratios into 4 or 5 major categories. I would like you to use at least one ratio for each of the 4 or 5 major categories. So that would be the minimum expectation for your ratio analysis. Do it over 3 years to show how the ratios for your company are changing over time. Also show a 3-year trend for, say, the 3 major competitors of your company. So obviously you're going to be doing quite a few ratios by the time all the smoke clears. When you look at the ratio, ask yourself some fundamental questions. How is the ratio computed? What is the ratio trying to measure? What's the unit of measurement? What does the value indicate? I mean, if you've got a quick ratio that goes from 1.0 to 0.5, what's happened? Okay, I expect you to be able to explain that. And finally, how can we improve the company's ratio? One of the things you may want to view yourself as when you do the project is you're a consultant to that company, and you're going to tell them what they're doing well and what they could improve on. The ratios should give you some insight as to what they could improve on. Okay, here are the major categories. Short-term solvency, also known as liquidity. Long-term solvency, or financial leverage. Asset management, or turnover. Profitability, and market value. I want you to choose at least one ratio out of each of those categories. Now, here's your choice for the liquidity ratio. I'm going to make this real easy for you. Do not use the cash ratio. I find that somewhat useless. So, you got 2 ratios to choose from, if not both, for the liquidity ratio. One is the current ratio. By the way, totally disregard the numbers that are shown on this slide. We don't have the backup material from which these numbers were pulled, so just focus on the definitions of the ratios. The current ratio is current assets divided by current liabilities. You want to be able to cover all of your current liabilities with the current assets. So by definition, you'd like that ratio always to be 1 or greater. The quick ratio, exactly the same as the current ratio, except we subtract out inventory. If you're liquidating the assets of a company, the slowest moving assets, you guessed it, are going to be the inventory. So by subtracting inventory, you're liquidating the fastest assets that you could get rid of. And if the inventory doesn't sell very quickly, it doesn't matter because you've already subtracted it from the numerator. So the quick ratio is current assets minus inventory divided by current liabilities. Leverage is a means of determining the debt of a company and basically how stretched the company is by financing with debt. You've got the total debt ratio, total assets minus total equity divided by total assets. You've got the debt to equity ratio, total debt to total equity. And then you've got an equity multiplier, which I don't give a lot of stock to, so skip that one. I'm not in love with either of these two ratios. Let me give you an alternative that you might want to consider. For the leverage ratio, I would suggest the current portion of long-term debt plus long-term debt divided by something called EBITDA. Now, why am I suggesting this? EBITDA is a form of earnings. It's earnings before interest, taxes, depreciation, and amortization. The numerator is all the debt the company has. It's the current portion of long-term debt, that's a current liability, and it's the long-term debt, which is a long-term liability. It shows how much of that debt is being covered each year by the earnings. So it's a very clean way to determine the earnings of the company and to figure out the leverage of the company. I prefer this ratio to any of the ones on the slide. So you might want to make note of this one. You get extra brownie points if you use that when you're taking a look at leverage. Coverage ratios, also known as turnover ratios, times interest earned. This is a really, really good one. A lot of bankers use this in one form or another. Times interest earned can be earnings before interest and taxes divided by interest, or it could be EBITDA divided by interest. Either one is acceptable. Just be consistent. If you're using EBIT to take a look at the company that you've chosen, then make sure you take a look at EBIT to interest for the competitors. Same thing with EBITDA. Just use the same thing for comparison purposes. Inventory ratios. This still falls under the turnover category. Cost of goods sold divided by inventory shows you how many times a year the inventory turns. Notice we're not using sales. We're using cost of goods sold. The reason for that is simple. When you buy inventory, it's part of a cost of goods sold number. We're going to find out in another turnover ratio that receivables are tied to something totally different. But inventory is compared to cost of goods sold. The days sales in inventory basically uses the exact same method methodology we use for inventory turnover, but we equate it to how many days they have inventory on hand. So you compute the inventory turnover, and then you take that number, the 3.2 times, and you make it the denominator for the next calculation. So you divide 365 days by the inventory turnover, and voila, you've got the number of days inventory typically stays on hand. This is going to sound very familiar. The receivable turnover, and if you're smart, you'll probably compute both. You'll do a receivable turnover, and you'll also do an inventory turnover. This can give you a lot of insight into the company that you're analyzing. The receivable turnover is not cost of goods sold, it's sales divided by accounts receivable. We're comparing apples to apples here. Once you compute that the sales to accounts receivable, in this case 12.3 times, you use the 12.3 as a denominator, and now you divide 365 days by the receivable turnover, and you get the average number of days they wait to collect their receivables. Give you some insight. If the company you chose is taking longer and longer over the last 3 years to collect its receivables, this is a problem. And this is something you should point out to the company. They need to improve their collection policy so they collect the receivables more quickly. We've got one other turnover ratio, total assets to sales, total asset turnover, sales to total assets. I don't think this has a lot of value, and I don't think this is going to give you a lot of insight. I would recommend that you spend your time on other ratios, not this one. Profitability is incredibly important. You want your company to be profitable. You want it to be showing improving profits. I put the profitability ratios way up there with regards to the key ratios you ought to be looking at. You've got profit margin, which is net income divided by sales. You've got return on assets, which is net income divided by total assets. And you've got return on equity, which is net income divided by total equity. I would recommend any of these. I would also recommend a fourth one called the EBITDA margin. It's the same EBITDA that we reflected on a moment ago. We put EBITDA in the numerator, and in the denominator, we would put down basically something that we could compare this to, most likely sales, because EBITDA shows you what percentage of profits are coming out of every dollar of sales. So if we make the denominator sales, we would call that the EBITDA margin for the company, and take a close look at how the EBITDA margin is changing over the course of 3 years. Is the company making more profits or less over this time span? And again, as a consultant, can the company learn something from what you're saying to focus more on profitability so that it's not having diminishing earnings each and every year? I mean, remember, the main task of the company is to have positive cash generation. If earnings are going down each of the last 3 years, the company's failing its mission, and that should be pointed out. There are also some market value measures. There's something called the price-earnings ratio, which you will see in the Wall Street Journal. The market price is the price you read in the Wall Street Journal or the price that you see on Yahoo Finance. In essence, it's the closing stock price as of a certain date. If you divide that by the earnings per share of the company, you get a price-earnings ratio. So in essence, you go through a couple steps. You figure out the market price, the shares outstanding, and then the price-earnings ratio. And you can also compute the market value per share to the book value per share. But when you get to the book value per share, it may not be information that's readily available. For that reason alone, I would say you may want to focus just on the price-earnings ratio of price per share divided by earnings per share. And in essence, that should give you a fairly good feel for what multiple of earnings the stock price is trading at. You will find that most companies have had their PE ratios going up over the last 4 or 5 years. See if your company is the same. That is it. For the Chapter 3 module, if you can get your arms around those ratios and standard size income statements and balance sheets, you're doing well. That's the end of Module 2.